Good morning, and thank you all for tuning in this morning. This is the final part in our four-part discussion on the sale of your business. I'm Micheal Burch, and I lead our Family Wealth Advisory practice here at Welch. We started our series, you may recall, speaking with Stefan May, and in that conversation, we were trying to determine how do you prepare for the sale of your business? What are the steps that you should undertake? We followed that up with a discussion with Ron Prehogan of Equitas Consultants. Part of this is how do you bring all this to your family, to your key employees? How do you bring it up with them? When's the right time to bring it up? If it causes friction, how do you deal with the friction? So that was very helpful. Then we met with Candace Enman, the president of Welch Capital Partners, and she sort of walked us through the process. What should you anticipate when you sell your business? So how do you properly prepare for it? What do you expect? What if you get an offer out of the blue? Should you use an advisor? How would an advisor create a competitive process? So all those things sort of brought us to today. And today's webinar is, all right, you've sold it. You've got some money in the bank, maybe some money still coming following the sale. What do you do now? How do you prepare for this post-retirement world? And how do you set yourself up? Because there's going to be a lot of different things going through your mind at this stage of the game. So from a housekeeping perspective, we're recording this webinar. It'll be available on our website shortly. And let's just get right at it. So to help make sense of all this, I'm joined by Elliott Bourgeois and Jeff Logan. Elliott is a manager of our Family Wealth Advisory division here at Welch. He has a master's degree in finance, certified financial planner, and has over a decade of experience. Jeff is the head of portfolio management at Harness Investments and has held positions with Purpose Investments, RBC, Claymore, and BlackRock in his over 20-year career in the financial service business. Welcome, gentlemen.
Thanks, Michael.
Thank you, Michael. Good to be here.
In 2019, Welch made the decision to provide the comprehensive financial wealth planning services our clients were asking for. In order to be completely comprehensive, we had to add to our skill set. With this in mind, we created the Family Wealth Advisory division. We collaborated with Purpose Investments to create our joint venture, Harness Investment Management. Our hope is at the end of this webinar, you will understand the financial planning process, why we partnered with Purpose Investments, and what you should be considering post-sale. And with that, I'd like to turn it over to Elliott.
Yeah, thanks, Michael. The Family Wealth Advisory was designed to provide truly comprehensive planning, where a wealth strategy is designed by looking at the whole picture, not just from one angle. To get it right at 10,000 feet, an efficient family wealth strategy, it needs to be built on a strong foundation. So experts with the highest level of accreditation in their field, and where the cogs of the larger gear are communicating with one another. And speaking of seamless communication, this is truly the ethos of the Family Wealth Advisory Group. We remove the onus from our clients to have to coordinate amongst their financial advisory team. And instead, we coordinate on their behalf and deliver aligned professional advice. Supplemental to that, as the life of our clients change and evolve, they don't need to repeat their story again and again. They tell a member of their financial advisory team, and that information is disseminated to the larger group. And one of those financial advisory team members is Jeff Logan from Harness Investment Management, who handles, well, surprise, surprise, investment management.
Thanks, Elliott, and thanks, Michael. As previously mentioned, Harness is a joint venture between Welch and Purpose Investments, and Purpose Investments is a Canadian investment manager that currently manages over $12 billion of assets for Canadian investors across equities, fixed income, and alternative strategies. The assets managed by Purpose are run by their investment committee, which has a wealth of experience managing money across all asset classes. And our portfolios at Harness are typically built using a blend of actively and passively managed ETFs. And this slide here is an example of many of the products offered by Purpose Investments, accessing a wide range of asset classes, geographic exposures, sectors, across stocks, bonds, alternatives, and commodities. And these are some of the examples of the investments used by Harness to design client portfolios, but in no way is this an exhaustive list. Harness is an open architecture, fully discretionary portfolio management firm with access to all stocks, bonds, alternatives, ETFs, high interest savings accounts, and other types of investments available in both public and private markets. So we offer all types of investment accounts as well, such as registered and non-registered TFSAs, RESPs, and a lot of our clients have corporate and trust accounts as well. So we're truly a one-stop shop for all of your investment needs.
Yeah, and I think that was part of it when we were deciding who we would partner with on this, that it was clear that Harness and Purpose could provide everything that we required. Elliott, you often meet with ex-owners who have recently had an exit event. What are some of the first things you talk about?
Yeah. So when thinking about retirement, setting goals is an important first step. It may seem a little counterintuitive. My goal was to accumulate enough wealth to no longer have to work, and I've done that. So why is goal setting still important? And the short answer, and indeed the pun is intended in this one, the short answer is purpose. Purpose has driven you to get where you are now, but the drive is not over. And many retirees, especially ex-business owners, struggle with the idea of letting go of their baby, having less responsibility, more time on their hands, things of that nature. So there's also a body of research, in fact, pointing to increased mental and physical deterioration in retirees that identify as bored or having less social engagement. So it's important to think about what your overall retirement vision is. Set some goals, both short and long term, and decide what activities you will do to replace the things that you're going to miss about work. If you're going to miss seeing people and interacting with colleagues, then maybe you join a country club or a board of directors. If you're going to miss being challenged professionally, which is often the case, then maybe you do some consulting, tutoring, mentoring as you wind down, or even the board of directors, as mentioned previously. A common goal that I hear often, and most people's goal, I know it's my goal in retirement, is to travel. But if you're traveling 10 or 16 weeks out of the year, it's important to have an idea of how you're going to spend the other 36 weeks out of the year. So as your advisors, will tie your vision and your goals that you've set out into a financial roadmap. So there's peace of mind that not only will your retirement be funded, but there's clarity in resiliency and flexibility in the options available to you.
And I'd add that Elliott and I and our respective teams spend a lot of time with each client uncovering their personal and corporate financial and tax needs. So we go through an extensive fact-finding mission with each of our clients to determine their risk tolerance and their capacity to take on risk and their required investment returns. And this is the basis used to design our investment portfolios that are most suitable to each client's personal accounts, trusts, corps, and even RESPs for their children. And just to be clear, it's not simply just Elliott and I working with the clients. We engage the entire investment team at Purpose Investments for portfolio construction and deep consultation with the tax and accounting professionals at Welch LLP to incorporate each client's individual tax, retirement, and cash flow needs. So at Purpose, the focus on investments is on risk management and meeting the required investment outcomes and goals, not simply beating a predetermined benchmark. So we care more about wealth preservation than we do about wealth creation, as most of our client base has already created their financial wealth. So Purpose manages money for Welch clients using the same strategies that large institutions use and pension plans use. So we take the best-in-class institutional thinking and apply it to our client portfolios. And Purpose is partly owned by one of the largest pension plans in the country, OMERS. We're also backed by a leading private equity firm and a very large financial and insurance institution, Allianz. So our core focus is building well-diversified portfolios, but with low standard deviation and attractive Sharpe ratios to help smooth out the ups and downs of the stock market. So we're not focused on trying to get you rich quick only to see it disappear in the next market correction. We take a very long-term approach to your investments.
Yeah, that's a good point, Jeff. really managing risk is key. And another important conversation that I have with new retirees is longevity and mobility. So not outliving your money, but also not failing to enjoy the wealth that you've created. A good plan will certainly contemplate your estate and legacy intentions and be robust enough to preserve those wishes despite any short-term market volatility. It is a concern I see fairly regularly. Will I have enough to live the lifestyle I want, but also support myself financially if I live to be 105 years old? A comprehensive plan will certainly address that. Now, on the other hand, a more common situation I witness is one where you've entered into later retirement, 80, 90 years old, living a more sedentary lifestyle. Maybe there's some mobility issues. Discretionary spending has decreased substantially. You're not eating out, you're not taking trips, or buying vehicles regularly. Maybe replaced with higher healthcare costs, but generally the sentiment is, I'm not as active or mobile as I once was. And yes, I have a plan to leave something to my ears, but their inheritance is growing larger than expected. And I should have gone on that European cruise or taken the family on that trip 10 years ago when I wanted to and had the ability to go. So certainly a give and take, but having a good comprehensive plan, one that's stress tested and updated regularly, can set the goalposts and allow you to make those informed financial decisions.
Yeah, I mean, that would be terrible to think that I'm going to run out of money and forgo a bunch of things that would have brought a lot of enjoyment in that time. So yeah, based on that, help me understand the process. So I just sold my family business. I've got the money in the bank. I have more coming perhaps. And I'm a bit worried. I'm a bit like I've run my business for 25 or 30 years. I've seen the regular cash flow. I know where my money's coming from. Now, all of a sudden, that sort of tap's been turned off. How do I get rid of these concerns about my financial future?
Yeah. In short, it's get a comprehensive plan in place, because that comprehensive plan is going to provide the clarity. It's going to provide the assurance that you want to feel comfortable. And people often assume that a comprehensive plan is the same as a retirement plan, but that is one part of the bigger picture. I like to think of comprehensive planning as having 6 foundational pillars. So retirement planning is one of them, but there's also cash flow management, risk management, investment management, tax planning, and estate planning.
Right.
As I like to think of this as a building and one that evolves and shifts over time. So leaning more heavily on certain pillars as it evolves, but always needing the 6 pillars to remain kind of level and efficient through its evolution. So for example, a comprehensive plan for somebody in their late 20s, early 30s, the main driver might be cash flow management, or a young family, maybe risk management, but investment management and retirement planning certainly can't be ignored if you want to be efficient. For the ex-business owner, either approaching retirement or in the early non-working years, cash flow management remains important, but has probably shifted from a question of debt reduction and savings plans to liquidation order of assets. Estate planning becomes critical. You want to outline what your legacy looks like to you. Is there a charitable component? Is a trust a tool we should lean on given the demographics and financial disposition of our years? In all of these examples, it's near impossible to have one pillar be completely efficient without contemplating the other 5. GF wouldn't be able to design an appropriate portfolio without knowing what the estate objectives are, what the outflow needs are, what are the tax considerations. Just like a retirement planning wouldn't be effective without contemplating someone's risk tolerance or tax strategies. So when we talk about getting a comprehensive plan in place, we're taking a current financial snapshot, we're understanding your future goals and constraints, we're analyzing the tax situation, building a proper forecast, and then outlining the options available so you can make informed financial decisions. Jeff and team have the architecture to implement the strategies that we outline.
That's right. And, at Harness, we offer a number of unique investment solutions as well that are not available at a lot of the other investment firms on the street. So, for example, we offer one of the highest yielding, high interest cash accounts as a place to park cash for short-term investment needs. We have a very powerful tax deferral solution that allows clients who hold low cost based securities the opportunity to roll these stocks into a well-diversified portfolio on a tax-deferred basis. Again, it's a tax deferral tool, not a tax avoidance tool, but allows you to spread those gains out over time. So it's a great tax planning tool for clients who have large stock positions, but they're hesitant to sell because of the large tax bill associated with the embedded gains in those stocks. So it serves all types of investors, from someone who's held a bank stock for many years to employees and executives of companies who have received stock options over their careers, to a lot of people now who've seen significant growth in tech stocks like Amazon, or many in Ottawa would be familiar with Shopify. And there's a lot of holders of Shopify who maybe should diversify some of their investment portfolios away from that. But this allows you to do that while deferring your capital gains. We also offer an income for life solution similar to a defined benefit plan, but available in a mutual fund structure that's very flexible and redeemable. So that's available to all of our Welch clients as well.
Yeah, and that's an important point, Jeff, in that, we're able to identify and offer these strategies and implement these strategies, because it's more than just me putting a plan together and Jeff creating a portfolio. The planning leverages the knowledge and of the tax and estate experts at Welch, and Jeff is not, picking ETFs for portfolios. It's a team of institutional quality portfolio managers and the institution to be able to offer these tax deferral mechanics that Jeff outlined.
So Elliott, you've mentioned efficiency a couple of times here as we've gone through this. So what are you considering when you're looking at retirement efficiency?
Yeah, and there's a lot of factors to consider, and maybe beyond the scope of a 1-hour webinar, but one big consideration is the layering of retirement funding and timing the inflow of taxable income. Taxable income and cash flow are two very different things in retirement funding. So the first non-discretionary source, which would be the first layer, is government programs. And they may be immaterial, but it's worth mentioning that once you turn on the tap for these government programs, then you lose the discretion that you had. So they become non-discretionary in nature at that point. So you're talking about CPP and OAS.
Yeah.
Max CPP is $1,200 a month right now, but many business owners are surprised to learn that their CPP entitlement is much less than the maximum, either because they were taking a smaller salary or a larger dividend, or potentially they weren't working or drawing a salary for the full 40 years that they needed to max their CPP. So I would recommend our listeners setting up a MyCRA account where you can view your projected CPP entitlements, just so that it's not a shock when it comes time to start drawing on that. Secondly, old age security, $615 monthly. Where we look at efficiency is trying to not get that clawed back, as it starts to get the claw back when taxable income reaches about 80K and it's gone completely at 129K. So, there's some efficiencies that we can look at. So let's say, for example, that you're planning to sell your business or an investment property, or really anything that will generate taxable income at 65 or 66. It could be beneficial to delay taking OAS, since really there's no point in taking it if you're going to get it all clawed back, and you'll receive a larger sum in later years of retirement. And then, sometimes there's going to be, if it's getting clawed back, it's because you're taking a lot of income. So that you can delay as well, and then you might not get it all clawed back. You increase the upper band where you would not see it all leave, really. And just one last point on the CPP and OAS, and this is pretty interesting, that there's a fair amount of complexity associated with this, but it's survivor benefits. And the basic takeaway here is that you can't get more than one maximum CPP retirement benefit per couple. So if two people are at 65 and are near or close to max CPP and one passes away, you're not going to get double CPP. It's just going to go up to the maximum. So that's definitely something to consider. Personal assets, however, RSPs, RIFs, TFAs, non-registered account, are generally more discretionary in nature and have lasting survivor and estate value.
That's right. And where Elliott and I work closely together is having a plan and an investment strategy that aligns with that second layer of retirement where you're withdrawing from registered accounts, for example, RIFs and TFSAs. So depending on cash flow needs and tax bracket optimization, we determine the best time to turn on the tap and activate income, which feeds into the evolving investment strategy. So we take into account not only the needs of our clients, but each investment account that the client holds. So we structure tax efficient portfolios for non-registered accounts and specific income requirements for RIF accounts and other important considerations for clients that have corporate accounts and trust accounts set up. So the investment consideration is not only important at the client level, but also at the individual account level.
Absolutely, absolutely. So, non-discretionary layers, government programs, you have a quasi-discretionary layer with your RIF, and then fully discretionary layers with non-registered and TFSAs. And often our clients have leveraged a kind of a holdco opco organizational structure throughout their career. So using the holdco to invest surplus cash from opco operations. And having a holdco in retirement provides a great discretionary income vehicle. You can withdraw dividends when required for lifestyle. And you have flexibility on the timing of these cash flows. So we can certainly be efficient around that while also navigating certain nuances like TOSI, the tax on split income. Another vehicle where TOSI might come into play and provides a discretionary income source is the use of inter vivos trust, which is another common structure that we see. So there are a few ways that a trust can provide benefits. So for example, if we've been working together pre-sale and the proper planning was in place, we can leverage the trust to multiply the lifetime capital gains exemption. So nearly $900,000 across all the beneficiaries of trust. But maybe there wasn't the planning in place beforehand, and the proceeds of the sale are outside of the trust or corporate are held personally by one individual. So establishing a trust with a prescribed rate loan can be a great option, where the holder of the funds would loan the money to the trust, and then you can sprinkle kind of income to the beneficiaries of the trust from the investment income. So when considering the sources of taxation of retirement income, Jeff and I look at the income needs and goals, plan for the timing of the non-discretionary sources that align best with your discretionary sources to minimize taxation and maximize estate value.
Yes, a lot of moving parts in all of this.
Yeah.
Jeff, a big part is your investment management. What are you taking into consideration when you contemplate sort of what's going to go into our portfolios? What's the best way for us to prepare for that sort of drawdown in our funds moving forward?
Sure. And many of our client portfolios are built using exchange traded funds or ETFs. So for those not familiar with ETFs, they're a diversified basket of securities, very well diversified, much like a mutual fund. However, ETFs offer some key advantages over mutual funds. So ETFs are very low cost investments. So fees are a really important consideration when you're investing. The compounding effects of fees over time can have a significant impact on your returns. ETFs are also very tax efficient investments, and many are available in a corporate class structure as well. ETFs are extremely liquid, meaning they can be traded at any point during regular stock market hours, unlike some types of funds that are only purchased or sold at the end of every business day, or in many cases, not available to be purchased or sold until the end of every month or quarter. ETFs are also completely transparent, meaning that all holdings are disclosed to our clients every single day. There's no secret sauce or anything that the investment manager or that we know as investment professionals that's about the portfolio that's not disclosed to our clients every single day. So the harness portfolios blend really the best of active and passive management when we're looking at investing. So where we want to use low cost beta market exposure to access certain sectors or markets, we'll buy ultra low cost ETFs from some of the largest money managers in the world, such as iShares managed by BlackRock, who is the largest money manager in the world, and Vanguard, who is the hands down leader in low cost investing and for the second largest money manager in the world. Where we think we can add value, for example, if we want to purchase high quality dividend paying companies, we'll buy actively managed ETFs offered by firms such as Purpose Investments. So our strategies are a blend of not just stocks and bonds, but we also add in alternatives to almost every portfolio that we build for clients. Some clients think of alternatives as high risk investments, and many of them are. However, the alternatives we use to reduce risk and volatility in your portfolio, the same way that pension plans think about investing and blend in alternatives to their portfolios. So we also use alternatives to diversify away certain portions of your fixed income, traditional fixed income exposure in this low rate interest environment. So in many cases, having too much fixed income can actually lead to negative returns relative to inflation. So alternatives are a key factor to look at in designing portfolios.
All right. Well, thanks, guys. Now I think we could turn to our questions. We got a lot of questions that have been rolling in. Start out with this one. So I have a holding company with an investment account. Should I withdraw to fund my TFSA or leave it in the corp?
Yeah, I'll field this one, and yeah, I like this question. It's one that we see very, very frequently, right? Is that you've got investments within a holding company, and you're benefiting from the tax deferral mechanics of that. Does it make sense to withdraw, pay a tax bill, and then invest into the TFSA? So, in terms of efficiency, really just the mathematics of it. It comes down to the propensity towards risk of the investor. So if the investor is very risk averse and the portfolio is not expected to generate many capital gains, and it's very income oriented, like if your bond portfolio or something like that, then the TFSA makes more sense actually, as it shelters this interest income. Conversely, if it's due to the tax advantage nature of capital gains under the current tax regime, and I think that's an important point, it makes more sense. It's a little more efficient to leave it in the corp. Now, it is because of that point, because under the current tax regime, it's slightly more efficient to leave it in the corp. We in practice, we generally recommend to top up the TFSA annually, even if the portfolio mix is slightly more efficient within a corporation. And the TFSA's contributions we're not talking material dollars, right? Of $6,000 to $6,500 of contributions. So the answer is so to answer that question, just on a pure efficiency perspective, is it more efficient in the TFSA or in the corp? It depends, but in practice, just maximize your TFSA on an annual basis for sure.
Yeah, and I would add to that there are some ways to take money out of your company tax-free. So if you happen to have a capital dividend account or something like that, and you do have room to top up a TFSA, then it makes perfect sense. If you're going to have to pay a higher rate of tax to get it out of there, you better determine what you're going to invest it in one or the other. So I agree, there are ways to get it out and do it, but often the tax bite at the start might dissuade you.
Yeah, for sure.
Okay.
For sure.
And why do we, this is a second question I have, why are people using trusts? How are trusts useful?
Yeah, so I won't loop back completely on the, we'll just touch quickly. It is a very popular tool, and a very effective tool to be able to provide some tax efficiencies, but also to provide some flexibility within a family group. So and we'll focus kind of more specifically on living trusts. There's different types of trusts, and
Sure.
you could use testamentary trusts for legacy objectives, which we would explore as well. But a trust can be helpful. One way is multiplying the lifetime capital gains, and that's a big one that we see. So if there's proper planning in place beforehand, and if you're anticipating the sale of your business, then setting up a trust and using all of the beneficiaries of that trust to tap into their lifetime capital gains can really, really provide some very substantial tax efficiencies. So that would be one. Another way that we use it often is with an estate freeze. So, there's been some growth, and there will be a tax bill when the owner passes away. So you want to kind of just limit that tax and transition more of a tax deferral, not a tax avoidance, but a tax deferral to the next generation using an estate freeze via a trust. And another one would be the prescribed rate loan, which is, given the current environment, the interest rate environment, it's a pretty attractive plan. So the prescribed rate loan, you can lock in a loan at the market rate right now, which is 1%, and it moves in whole numbers, so it won't ever get lower than 1%. And you would loan to the trust, and then the trust would pay the loaner the prescribed rate, the 1%. But then all of the income earned through the investment within the trust can be allocated to the trust beneficiaries and taxed in their hands. So it provides a lot of flexibility rather than just giving a prescribed rate directly to the individual, because you're kind of locked in terms of the payment, and then also you're loaning that money to the individual, and they can do with it what they please. So you have some control over the investment strategy as well.
Yeah, I think that's part of the key, is that sort of maintaining a semblance of control at the very least through the trust. Yeah,
absolutely.
So, Jeff, you had talked about employing alternatives in our portfolios, and you even sort of referred to the fact that people view alternatives as sort of these risky hedge funds and things like that. What exactly are the alternatives that you would use to protect against the downside?
Exactly. Yeah, we use alternatives for risk management, primarily two things: risk management and downside protection, and also diversification, often in place of fixed income exposure because of the low interest rate environment right now. So, for example, many of our portfolios have an allocation to gold, and this isn't buying risky gold mining stocks or anything volatile. It's actually buying physical gold bars stored at the Royal Canadian Mint down the road from the Welch office in Ottawa. Another example would be we use an options-based strategy that uses cash-covered puts to generate an attractive yield, while at the same time limiting the downside exposure when markets move lower, if and when they do. We also use right now a real asset fund, so it has holdings in energy, agriculture, precious metals, base metals, in both equities and futures as the portfolio construction in that real asset fund. So.
And would you have, COVID's pretty much changed everything in our world. Would you guys have changed your investment strategy post-COVID, or has that had an effect?
Yeah, we've certainly made some changes. I mean, our portfolios are really designed to be resilient, long-term, well-diversified portfolios. So we're not actively trading our positions on a daily or weekly basis, but post-COVID, our investment committee does meet much more often than we have, and we have made several portfolio changes, as we position to take advantage of the post-COVID New World Order. So, for example, we've added more exposure to the NASDAQ or technology stocks. So technology stocks were traditionally a much more risk-on play, but now we view tech stocks as a much more defensive in nature post-COVID. So another example I talked about, we added some gold bullion, so as a store of value and a way to diversify our portfolios away from the market. In fixed income, right now we're using actively managed corporate and high yield bond funds to better navigate the interest rate environment. So, and actually all of those strategies that we've added post-COVID has added nice returns to the portfolios over the past year or so.
Excellent. So I guess one last question we're here, which it might be a bit weird, but RIF meltdown, what is that? So someone's heard of RIF, RIFF meltdowns. What is that?
Yeah, I saw that. I saw that question in the chat there, and I'd be curious as to who might have advised them to do this, or if they've just seen it and were curious about it, because it is not something that we generally recommend. But the idea behind a RIF meltdown is really to convert your registered assets, your RIF assets, that will be taxable on withdrawal into non-registered tax-free assets. So the idea is you offset the income from your RIF, which is taxable income, with the interest on an investment loan. So, quick example, you borrow $100,000 at a 2% interest rate, you have a deductible interest payment of $2,000. If you withdraw $2,000 from your RIF, then you can deduct that. You have the 2,000 income, and then you can deduct the $2,000 interest payment, and the two even out. But yeah, we generally don't recommend the strategy for two reasons. One, it's inherently risky at a time when you likely have a lower risk tolerance, right? This is, if you're withdrawing RIF income, you're likely in your 70s, and it's probably not the best time to be taking out an investment loan at that point in time. And second, the interest costs are tax deductible to generate income, but capital gains are offside on this. So you need to be able to generate income with the investment loan. And Michael, I know in your experience, we navigate the CRA on an annual basis at minimum. So usually it's okay to invest in a well-diversified portfolio is a good excuse to, or a good reason for generating income, which allows the investment loan interest to be tax deductible. But the CRA is kind of circling around this one, and the tax regime is always evolving and changing. So it's not, certainly not something that we generally recommend. A RIF.
Yeah. I mean, I think at that stage in your life, taking that additional risk doesn't really make a lot of sense, and it sort of loops back to a bona fide financial plan. If you've got a plan in place that sets up your guardrails and makes a clear example of what your sort of desires are, then why would this wouldn't fall into it necessarily? I was also thinking that there are times where, depending on your level of taxable income, it might make sense to draw more from your RIF even in advance of when you need it. But if it can come out at a lower tax rate than what might happen on death or at the end, if it's, if you don't have a spouse to leave it to or something like that. So
yeah. And another quickly on that, it's oftentimes it would make sense to just unlock a little bit of the RSP, right? Even for that pension income tax credit, because if you don't have a pension, you're losing the pension income tax credit, quote unquote, from 65 to 71. If you wait to convert your RSP into a RIF all the way to 71. So there is and RIF income qualifies for the pension income tax credit. So there's $2,000 of RIF income that you can essentially get tax free on an annual basis with the credit. So yeah, for sure.
So I think that's it. I mean, this has been a great little session. Thanks, guys, for joining us, and thanks to all the people that are watching, tuned in, and stay connected. We'll be back with some more. Thank you very much. See you guys.
Thank you.
Thanks, Michael.
Okay.